All right. Good morning, everybody. The Eagles, Doobies, Doors, like that, man. I can get with you on the Eagles and the Doobie Brothers, Ron, but the Doors, just not my thing. Not my thing at all. Good morning, everybody. Good to see you guys on this beautiful Thursday morning, the 28th day of December. Skies are calm, winds are cool, and we are going to set sail. Just kidding, having fun. Hope everybody's doing well today. Hope you guys survived yesterday. The market was very range bound yesterday as they slipped back into getting into trading mode. This morning, crude oil seems to be moving really well. We do have crude oil inventories today at 11 a.m., which is always a potential market mover. And I know that it's at 11 a.m. because every morning I go to forexfactory.com/calendar. And I'm looking to make sure that I'm not trading into news. Good morning, Kat. Morning, JW. So each and every morning I go and I look at the news. It's Thursday, December 8th. At 8:30, we had a couple medium impact unemployment claims, some low impact goods trade balance. At 10 a.m., we're going to have that pending home sales, which is a medium impact news, guys. And what that means, it doesn't mean that we're waiting to see what's going on in home sales. What we're doing is we're just saying, hey, somebody may react to this. Maybe I should sidestep. Maybe I should not be in the market. Maybe I should protect my position. Whatever your plan says, my plan says just avoid it. I won't trade personally into medium or high impact news. If I'm in a position, I'll flatten because it's important to me that I don't get caught in that little emotional wave. And the people that move the market tend to be emotional. At 10:30 a.m., if you're a natural gas trader, well, you want to be aware of that. But at 11 a.m., guys, we have crude oil. Typically, it's Wednesday. Typically, it's 10:30 a.m. So today, it's a little different. Write yourself a note. Set a timer. But crude oil inventories is when they release the reserves, which means for the crude oil trader that the morning may be a lot of jockeying for position, waiting for the news release. And then at 10 or 11 a.m. when they release it, somebody may just drop an awful lot into the market or take a lot out of the market. And crude oil tends to spike or bump. So, guys, give me a Y if you can hear me. All right, cool. Thanks, guys. Let's see if we can get Andy back on track and get him squared away. And I will see if I can get him some help from the sidelines. Awesome. Cool. Thanks for that. And I sent a little note for him there, and we'll see if we can get him squared away. And guys, if you ever can't hear, type it in the room and let me know. And if you see a flood of Y's come in, then you know that you're that the issue is you and not me. But there are times when I have allegedly muted myself and had brilliant conversations with you guys that you never heard. So always tell me if you can't hear, and we'll always see if we can get it fixed. And then I typically will reach out to the sales team to get them on with you to help as well if you need it. All right, so news each and every morning, checking it. And then everything that I talk about, guys, each and everything that I talk about comes from the tutorials section, comes from the education page. Not a lot of secrets with Nexgen. We will give you everything that you need to be successful with the software. I want you to believe that. The only thing that Nexgen can't provide you is repetition, is experience. So I'm going to give you the best plan, and this is what our first hour revolves around. Giving you the best plan to intelligently practice, to practice with focus, to practice with purpose, and really to practice like you're going to play. So we're going to focus, and I'm going to go right to the tutorial section. Same thing as every day. If you're brand new, I'm going to tell you right now, the first hour doesn't change much. But we're going to focus on what's called a high probability trend trade. It's right here in the glossary of common terms. And it simply means that each indicator on every chart is going to agree for the trade, guys. This is where your triggers are the strongest. This is where there's nothing in the way. Nice job, Lyle. First $600 trade. I dig it. Shut it down and go golfing. Do that every day. Make 12 grand a month. Great job, Lyle. Post it in the room. We all want to see it. A high probability trend trade is your foundation, guys. A high probability trend trade is, you have to listen to me. Apparently you have been. Good job. Still want to see it though. What happens, guys, is when you learn this high probability trend trade, what you're doing is you're teaching yourself to gauge advantages. You're teaching yourself to recognize advantages. And a high probability trend trade, let me go to my 3 trading rules here. A high probability trend trade is just going to turn you into a chart reader. It's going to give you the information that you need to be able to look at your charts and understand where the market is likely to continue. And that actually becomes your entry for the highest probability trend trade. Your entry points will change probably drastically as you grow with the software, but in the beginning, you're going to be able to pinpoint where the market is most likely to continue and use that for entry. You're going to understand where the market is likely to go. Lyle, you put way too much faith in my imagination. Way too much faith in my imagination. I'm not even looking at charts. When you understand where the market is likely to go, and it's very possible that that's what Lyle just did, he knew where he should be taking profits. You'll be able to recognize trouble spots in front of you. You'll be able to utilize momentum to tell you that the market's likely to get to that next spot, and where the market is likely to go is going to become a very big part. Well, Lyle, we have to fix that. We have to get you to where you can post a picture because, man, that's what it's all about. And then, guys, finally, you're gonna understand where the market is likely to stop. You're going to be able to look at your charts and you're going to be able to say, holy smokes, I've reached a big red fib, or I've reached one-to-ones or a divergence line. And the recipe is simple, and I know that the market may stop here, so I'm not going to take that next trade. Where the market is likely to stop is what we call a termination condition. And these actually have 2 uses with what we do. The first one is they tell you no more trades into the area. No more trades into these key areas that may stop, that may reverse. But it's also going to act as an anchor. When the market reverses off one of these key areas, and you're going to get the recipe for it, and you'll be able to figure it out very quickly. The high probability trend trade that sets up after a reversal from these likely to stop areas, guys, that's your best of the best. That's your first 30 days and beyond. This is a trade that typically wins 70 to 80% of the time. This is a trade that creates an awful lot of confidence through the memory of success. And this is what we focus on for the first 30, or really for the first 30 days, guys. Most people are getting their entries within the first 10 to 15. Give yourself a little time. Give yourself a little grace. You are brand new, or you're just getting back into it, and you're really focusing. It's okay to make mistakes. I actually encourage mistakes because mistakes are how you learn. Mistakes are how you grow. So we're going to focus on this high probability trend trade, and we're going to let it have 3 rules, guys. That's it. We're not going to build more rules in our heads. We're not going to create conditions that aren't a part of this set of rules. And what you're going to find is that each rule provides you an advantage, and the advantages that come together create a high probability trend trade. Rule number 1. All right, let me see if I can help Andy real quick. All right, guys. I will always try to be helpful. If you can't hear me and you really need help, I'm still not going to be able to hear you. So call your salesperson, call tech, get on with somebody that can help you out there. There's a lot of things I can do if you can hear me. If you can't hear me, it becomes difficult. So I don't want anyone to miss anything. Close that out. So we're going to take 3 rules, and we're going to let those 3 rules give us 3 advantages. The 3 advantages become a trade. Your large chart, strong triggers will provide you momentum. None of those termination conditions are going to give you a clear path. And then we'll use rule number 3 to define where the market is likely to continue, and that becomes the entry area. These 3 rules, guys, are pretty simple to learn. It's just going to be a little visual recognition. And then we're going to have them, the 3 rules are going to happen on only 2 charts. And I just want to remind you guys that are new, the first hour I will go over all of the rules. The second and the third hour, we're going to talk about your charts. If you need to leave before that second hour starts, just let me know, and we'll take a look at what you're doing, and I'll give you feedback on it. But if you're able to stay for the entire class, I will get to yours just once that second hour starts. 2 charts, guys, for 3 rules. That's it. And your large chart is a big broad stroke of a brush. The large chart leads the way. That's one of my favorite phrases. The large chart is going to define the direction of the market, which way you should be trading. And the large chart is going to tell you whether or not you have that advantage of momentum through rule number 1. And the large chart is going to define areas that can be problematic. And this is a key point. The large chart's going to define the areas. The large chart's going to let you know whether or not you shouldn't be taking that next trade. That's rule number 2, making sure that there's nothing between you and your targets. All of this happens on 1 bar. The most current bar on the large chart is gonna define direction, momentum, and areas. And when your rules are met, when you have momentum, when you have nothing between you and your target, which we're going to call a clear path, that's when you'll go to a smaller, faster chart. And this is a refinement chart. What happens in this 1 bar on a large chart is going to come together in 15 to 30 bars on a smaller, faster chart. It's going to literally take that broad stroke and refine it all the way down to the point where the market is likely to continue. And by doing this, by using this refinement process, by letting rule number 3 get you in at that point, you're going to reduce risk. And reducing risk is huge because we always manage our risk before we manage our profits. But it is going to increase your profit potential because we're literally going to take pullbacks, little regressions in price, and then go on with that momentum, with that direction. So 2 charts and 3 rules, guys. We're going to keep it very, very simple in the beginning. And I want to show the picture of why we use 2 charts. Guys, the large chart's the large crowd. The large chart is what the people with money want to have happen. And the large chart defines that direction, those areas, that momentum. And this is all because the people with the deep pockets are making it happen. It doesn't do us much good to fight the large crowd, guys. It's like walking against foot traffic in New York City, right? You're just going to get bounced around and frustrated. The small chart acts as the small crowd, and the small crowd are the people that don't mind fighting the large crowd, and they're going to create these little pushbacks, these little blips in price, and that's going to push you right back to your best of the best entry. So large crowd, small crowd. Your job is to be a part of the large crowd, to let the large crowd lead the way, to give you momentum, to give you a clear path, and then your small crowd's going to push you right back to that great entry. Every day I go over what it's going to take to get you where you want to be. And it begins with posting in the room, guys. It begins with being comfortable with putting pictures in the room. Don't be afraid to be wrong. I want you to be wrong because when you make a mistake, I don't want to say you're wrong, but if you make a mistake, if there's a misunderstanding of the rules, what your pictures do is they open up the door for conversation. Maybe you're telling me that you had the best momentum ever, but you really didn't. It gives us an opportunity to go back and talk about that momentum. We can talk about what you see. We can talk about why you did what you did. And every time you post in the room, it's going to be like a private session. You and I are going to have a conversation. And the key is you're going to tell me what you did. And guys, I want you to save this picture because this is the most important thing you can do as we talk. Tell me why you did what you did. And there are no wrong answers. Like, I'm not going to tell you how to feel. Well, Mark, everything was green, so I went long. Outstanding. Show me where you went long. Tell me where you entered, because there may have been a better place to do it. There might have been something with less risk. There might have been something with more profit potential. Let's work together to find a better entry, or let's just virtually high five. Great job. That's the best entry. I couldn't even think of a better one. And then tell me where you got out, because we're going to talk about management a lot. We're going to talk about these key areas and how you're going to be able to sometimes take profits almost at the high tick utilizing these areas. So the more information that you give me on a chart, the better your feedback is going to be. And that's what's going to drive you to the next level. And then the second thing is that real-time performance in your spreadsheet. Nexgen provided you a spreadsheet. It's in your Nexgen study picks plan license agreement. It says Nexgen 90-day training, guys. This spreadsheet is your trade journal initially. Every time you take a trade, win, lose, or draw, you're going to take a picture, you're going to annotate why you did what you did, and you're going to drop it into your spreadsheet. And your spreadsheet has drop-down menus, and you'll be able to answer a lot of questions. And let me show you. How did I feel? It's going to ask me, was I nervous or confident, jumpy, frustrated, bored? Did I have a good top or bottom? What were the conditions? Were the rules met? And what was my outcome? And what happens is you're going to get in the habit of filling these out, and it's going to kind of reinforce your ability to follow rules. And then when you post it in the room and you start getting that feedback, drop it in your notes section. Hey, Mark said that I traded into a termination condition. That may have had something to do with my loss. The feedback was that I took the perfect high probability trend trade. Let me make sure that I never miss this one. But every morning, give yourself 5 minutes over a cup of coffee to look at what you did yesterday. What were the trades that you took yesterday? What worked and what didn't work? And what made you comfortable and relaxed? And what made you nervous and tense up? In this little historical study each morning, it's going to prepare you for the day, guys. It's going to set you up because you're thinking about the things that brought you success, and you're thinking about the things that may have taken that success from you. And if you do this every morning, if you post in the room, if you fill out your spreadsheet, if you go back and study that spreadsheet, guys, it will accelerate the learning. You'll actually be amazed at how quickly you get to where you want to be. And then we're going to take the first hour to learn the trigger line and Fibonacci rules for when it's okay to trade. We're going to talk about those 3 advantages. We're going to look at what they mean visually. And we're going to associate them with the looks on the charts, the words, so that they come together. So not only can you recognize them, but you can write on your chart, this is exactly what I'm looking at. And we're also going to have you guys simulate. I want you to not be afraid to pull the trigger. Don't wait until you think you have it. Get in there, break as many eggs, make your omelets, whatever cliche you want to use. Because what we're going to do is, it's like a scatter gun. You're going to hit everything at first, and then we're going to work together and we're going to refine that into the absolute best of the best, trading those advantages for when it's okay. I simplify a lot, guys. I try not to give you things that you don't need. I'm not teaching you to build a watch. I'm teaching you to tell time, right? We're not concerned about the mathematics that go into the indicators. I don't know them. I really don't. I was an English lit major, guys. I'm an artist. But I can read charts, and that's what I can teach you. So we're going to simplify. We're going to look at 3 rules, 1 trade, and then we're going to add on to that one. Once you have that skill set of understanding those 3 advantages, I'm going to give you what's called a medium probability trade. And a medium probability trade means that most of your indicators line up for a trade, but a small issue is going to exist. Your issue is going to be either a lack of momentum, your path won't be clear, or your entry area may not be perfect, guys. And when you have a medium probability trade, your ability to read charts is going to recognize what the issue is. Your ability to read charts is going to allow you to manage assertively. You'll be able to get to a 0 loss level ASAP, maybe take some quick profits. And that's what we're going to do. But what looks are you going to commit to, right? What does it look like when your rules are met? What does it look like when the best of the best is happening right in front of you? And you're going to be able to go back and study this, and you're going to create recognition through repetition, guys. You're going to go through and you're going to take those pictures of rules met trades, and when you have one, you're going to drop it into your personal trade setups. What does my perfect long look like? And it's going to look like this, and you're going to say, all right, well, when the market does this, I'm not going to miss it because I'm looking at it still. It's going to make it easier to catch it in motion. And you're just going to continue this process. So that's the second page, guys. You're going to put your trades, your best of the best in there, no matter what they are, and begin to formulate a plan for yourself, a concrete set of rules that is your absolute must to enter the market. And then on the third page, the client trades, I've really just stolen a lot of pictures from you guys as you post them in the room. And the client trades, the entire green section, let me scroll over, it's about 275 pictures of high probability and medium probability trades. It's about 275 pictures of you guys using your chart reading of the software, finding success with it, or taking the perfect trades even if they don't work. But what happens, guys, and I'm telling you right now, if you're new with me, dedicate an afternoon and go one after the other and just look at them and start burning into your mind the idea of momentum, the idea of the perfect entry, the idea of termination conditions, and make it so that it becomes easy to recognize. And I dropped my spreadsheet in the room. You can steal all those pictures. I'm not sure how many of them are on there when you download it from the site, but that's what we're going to do, guys. We're going to learn some rules. You guys simulate, post them in the room, and we're going to keep it simple. 3 rules, 2 charts. That's it. And the first rule, where'd it go? There it is. The first rule says that we must have strong trigger lines. And strong trigger lines, probably the easiest lesson you're going to get today, outside of this one. Strong trigger lines only happen when you're trading with the direction of the market. So let's use the background on the large chart to determine which way we should be looking for rules to be met. If the background is green, I'm only looking for rules to be met for high probability trend trades long. Notice that I didn't say I'm going long, because we want the rules to be met, want the advantages to be in place. We're not just going to arbitrarily go a direction because of a color. But up, green, keeps me focused on having the rules in the correct direction. When the background is red, market's going down, so I'm going down with it. I'm looking for my rules to be met for high probability trend trade short. And I asked the question at the top, and these are for the people that have a little bit of experience. If you never fought the trend, if you never fought that direction, how many mistakes would it eliminate? Because, guys, mistakes tend to cost us money. So if we can focus on just going with the direction of the market, we can eliminate tossing money into the fire there. And then in order to have strong trigger lines, the trigger lines have to match the background. So if the background is green, both your small and your large triggers must be green. And if the background is red, both sets of triggers must be red. Of direction, Lyle? Lyle, I want you to learn to take pictures today. That's right. That's odds favorable momentum. Very nice. We're going to take pictures today. I got you. So what Lyle's saying is that he has strong triggers on the S&P right now. What does that mean? Small triggers are these solid lines. They're a fast-moving indicator. Large trigger lines are these dashed lines. They're a slow-moving indicator. These two work together to provide you strong triggers. So when your small triggers break above the large triggers, when space is created, very much like scissors opening up, ready to cut, this is what we call strong trigger lines. Everything is green. Triggers are wide and angled in the direction of the trend. And when I have this strong trigger look, when there is space between the two, the odds are favorable for the market to continue in the direction of the trend. And odds favorable momentum is the first advantage. This is what rule number 1 does for you. And in a downtrend, small's below the large are wide, they're angled in the direction of the trend. That space between the two lets me know that I do have odds favorable momentum, a market that is likely to continue in the direction of the trend. And then Lyle absolutely nailed it. This most current bar, my smalls are below the large are wide, they're angled in the direction of the trend. Guys, this is your best of the best look. This is the look that sets the tone. This is the look that creates the advantage of momentum. And the flip side of momentum is weak. And when you have weak triggers, anything can happen up or down, guys. Weak triggers precede reversals. Weak triggers don't give you that warm fuzzy that the market's likely to continue in the direction of the trend. And I want you to see, using the exact same chart, Notice how the small triggers return to the large triggers. The large triggers weakened right there at a key area, and sure enough, that precedes the reversal. And then we're going to be able to use these strong trigger lines, this advantage of momentum. When we have it, it is the most favorable look for buying Fibonacci support on that smaller, faster chart, or for selling Fibonacci resistance on that smaller, faster chart. And on a large chart, that slow chart, that broad stroke of a brush, all you're going to see is this tail, this wick after the fact. You're going to be like, oh, look, there's a tail with odds favorable momentum. This tail is your pullback on a smaller, faster chart. You are going to be able to pinpoint right where the bottom of that tail is most likely to continue. And you're going to be able to pinpoint right where the top of that tail is most likely to continue. And you're going to use this as a study tool, because when you have odds favorable momentum and you do have the rules met, if you circle these tails, you can see the pullback on a smaller, faster chart, giving you a potential entry to continue with the momentum. So we're going to use these tails as a study tool. Embrace the idea that momentum leads the way, that momentum is an advantage. And I took some pictures this morning. Guys, this is odds favorable momentum. This is the best of the best. This is a look that pushes the market in the direction of the trend. Whoops. This is the look that breaks areas that may normally stop the market with that much momentum, have the potential to break. And then the flip side of that is weak triggers. And this is your weak triggers, guys. It's a tired old donkey pulling a rickety cart, and it just doesn't have much drive to push that market any further. And use these visuals, and while they're a little comical, right? What it does is it reminds you that one look is phenomenal. One look is a bullet train taking you to your targets, and the other look, man, you're kind of hoping you get to the fields. So rule number one, odds favorable. Is everybody comfortable with that? If you're brand new, give me a Y in the room and say, hell yeah, Mark. Odds favorable, I got it. What a great advantage. I can't wait to take trades with odds favorable momentum. Odds favorable momentum should be that one that I just don't give up. And then once I have it, actually, you know what, before we talk about having it, let me remind you that we're chart reading, right? We're waiting for these advantages. They're not going to be prevalent all day long. And rule number one isn't going to happen all day, every day. And you're going to get that separation, that push, and it may bring you all the way to those anything can happen triggers. And there's your reversal, right? Very often there's Fibonacci support or something right here. This reversal pushes you the other direction, gives you odds favorable momentum. You guys are going to pinpoint that entry right there and carry it up right to the weak triggers, which precedes another reversal. Odds favorable, there's your tail, market continues down. Guys, this is cyclical. It's going to happen both ways all day. That's one of the beauties of what we do is in futures trading, we don't care if it goes up or down. We care if it has odds favorable momentum and a clear path, then we'll look for an entry. We can make money either direction. But sometimes you're going to hit a transition phase. Sometimes the triggers aren't going to agree with one another. Remember, everything has to be the same color for it to have the advantage of momentum. Sometimes you're larger down, but you're smaller up. It's impossible to have odds favorable momentum. Sometimes your triggers are down, but your direction is up. You can't have odds favorable momentum. And these are with the people that control the market, the buyers and sellers. Guys, they're fighting it out for supremacy right now. Very often you'll see this happen in between two key Fibonacci areas, in between divergence lines. And you can literally, through rule number one, avoid being caught in this fight. Avoid the temptation of creating opinions about what the market's going to do based on a color. And if you just sit tight, hold on to your money, eventually someone's going to win. Someone's going to give you that odds favorable momentum. But it takes a little patience. 90% of your day is spent reading your indicators, waiting for those advantages. 10% of your day is going to be just pouncing on it, taking that high probability trend trade because all of the advantages are present. So strong trigger lines, guys, they break things. They push a market in the direction. I've got people in this room that have developed trading plans that revolve around primarily odds favorable momentum. But once you have it, you got to make sure that you're not trading into an area. That's a very key part, guys. These fibs are unbelievably powerful. Whoops. Hey, little donkey. And these fibs are where decisions are being made. Sorry, I closed out my picture on accident. You waited 4 hours for one good trade yesterday? It happens some days, doesn't it? Guys, we're still holiday trading. Until after New Year's, we're holiday trading. Areas that may stop the market. Guys, these are areas, and I want you to think of it this way. These are areas where decisions are made. These are areas where the buyers are going to buy and the sellers are going to sell. These are the areas where profits are going to be taken. And these are also the areas where fights are going to be had between the buyers and sellers. In the areas that we're looking for on the large chart, remember, large chart defines areas, is we're going to look for red Fibonacci resistance and we're going to look for blue Fibonacci support. And guys, you're going to know about these areas typically hours before the market ever reaches them. We're going to look for these yellow 1-to-1s. And then we're also going to look for divergence highs, which are these dashed lines, magenta, coming from a pivot. And all this is divergence for the sake of Nexgen, guys, is divergence means there was a loss of momentum. And that's it. Don't overthink it. You're going to see a negative number print, and the negative number means nothing. It's just a number. It's a byproduct of creating this magenta line. But when this magenta line prints from a pivot, and it won't print to like the third bar down, you know that there was a loss of momentum in the move up. It means that the sellers stole the momentum from the buyers. And we're going to use these divergence lines as potential lines in the sands where decisions are being made. From a low, if the buyers steal the momentum from the sellers, right about the third bar up off the pivot, you're going to get this cyan dashed line that prints. And this is just a visual indication that momentum was lost. But there's a recipe for getting a hold of areas likely to stop the market, making sure that termination conditions are false, that you're going to have room to your profit targets. And I'm going to go back to the user guide straight from the tops and bottoms area. And I'm going to show you the recipe. And I'm going to take a picture of a picture. I know I've got newer people here. I want to make sure that you guys are good with this. Everything starts with price reaches an area. Price reaches the area. That is the catalyst for decisions being made. So I'm going to highlight that. Price reaches. When these dynamic Renko bars come down and reach Fibonacci support, the only thing that you have to do as a Nexgen user, the only thing that you have to do is ask yourself, where are my trigger lines? If the trigger lines, the same trigger lines that establish that momentum for rule number 1, are above the area of support, the only thing that you have to do is absolutely nothing. And just say to yourself, hey, price reached an area, the triggers remained above, I don't know what's going to happen. I don't know if it's going to create an untradeable bounce. I don't know if the buyers are going to take over. I don't know if they're going to fight for the next 3 days. I have absolutely no idea. But if price reaches an area, in this case support, and trigger lines remain above, you've reached a termination condition. It's okay to do nothing because it's either going to break and give you a clear path, or it's going to reverse and set you up for the highest probability trend trade ever. An area is considered broken, and I want you to see this. Price reaches support, smalls and large remain above. When both your large triggers and your small triggers get below the area of support, support is now behaving as resistance. The area is broken. Small and large must break through the area entirely. And then support is broken. It begins to behave as resistance. And one of the cool things that you'll notice here is that when the area is broken, you have odds favorable momentum. And with that odds favorable momentum, you've added a clear path, room to your target. You guys are going to pinpoint right where the top of this tail is most likely to happen. This is going to become your entry for a high probability trend trade. This is going to become your entry point to use that momentum to get all the way down where the market is likely to go, which also happens to be where the market is likely to stop. Is everybody good with the basic recipe? If price reaches an area, wait for the triggers to break. Otherwise, the path isn't clear. Sit on your hands for a minute. Wait for the decisions to be made. If both small and large get to the other side of an area, now the area is broken. The path is now clear. We'll begin looking for our rules to be met to get to that next key area. Guys, this is your high probability trend trade scenario. This is as black and white is I know how to make it for you guys. And it's really just two options. Either triggers have broken or triggers have not. Either the area is a termination condition or the area has broken or reversed the market. And if you allow it to be that simple, if you insist on a clear path as a new user, you're going to eliminate a lot of mistakes. You're going to find yourself not caught up in the decision-making process of the people that are capable of moving the market. But we talked about a medium probability trade, and I want to talk about that as well, guys, because this medium probability trade is probably going to be your first trade outside of the high probability trade. And it revolves around the potential for an area to break. And that word potential is very key here. Because when you have odds favorable momentum, remember, odds favorable momentum breaks areas. And your small triggers absolutely smash through the area in question. Here, price reaches, we're doing nothing, but the smalls absolutely smash through. The momentum is the best of the best. There's a huge gap between small and large. Well, now this 69.80 area has the potential to break. But it's not broken yet because the requirement is that the large triggers get to the other side as well. So this is what we call a 50-50 look. And 50% of your trigger lines are through the area and 50% are not. 50-50 has nothing to do with the odds of success should you decide to take a trade. But 50-50 lets you know that this area has the potential to break. But the path isn't clear. And if the path isn't clear, well, then you can't take a high probability trend trade. The recipe isn't met. You only have momentum with the odds favorable momentum, and it's going to be key that your entry is low risk and very easy to recognize. And you should insist on the absolute best of the best when one of these advantages goes away. And this is going to be your second trade, guys. This is going to be your 50-50 trade, and I am going to provide you a plan to know how to take it with the best case scenario of success. Because if you look over here, you'll see even with odds favorable momentum, even with the tail, ultimately that market headed back the other direction and broke the areas above it. So I'm going to give you a recipe for the best of the best on that 50-50. But your ability to chart read is going to make it to where you can take it, guys. And here's some pictures. Termination conditions at a high. The left slide shows you a pivot with a loss of momentum, and that's all it is a pivot with a loss of momentum. It's not a termination condition. The pink line just says that momentum is lost. But when price reaches the area, the first part of the equation, and triggers remain below, now it's a termination condition. And if this termination condition reverses the market, we're going to call it a strong top. Resistance, triggers remain below, even with odds favorable. We've reached a termination condition, sit on your hands, and the same thing over here. And what happens at highs is going to happen at lows, but the recipe never changes, guys. If price reaches an area and the trigger lines remain above that area at a low, just sit on your hands and do nothing. Sometimes there's going to be a fight. Sometimes there's going to be an instant reversal. Sometimes there's just going to be a broken area. But it's okay to do nothing while you wait to see what's going to happen. And if the termination from a low creates a full reversal, well, then we have what's called a strong bottom. And that's the precursor for the highest probability trade that you can take. So the very basic recipe. Is everybody okay with that? Price reaches Fibonacci resistance. The triggers remain below. Let's not go long. Let's wait for the reaction. Let's see what they do. And the reaction here pushes them all the way back to support. And you have to just start the process over, guys. Price reached support. None of the triggers have gotten through it. They all remained above. Therefore, I'm not going long, or I'm not going short. I can't go long into resistance, and I can't go short into support, guys. This is my 90%. I'm sitting on my hands, and I'm waiting for the advantages. Price pulls all the way back up to resistance, a divergence high, a second resistance. All of the trigger lines remain below, guys. This is what we call a pivot stop out. When price reaches that divergence line and trades back the other way, it's powerful. When it happens at Fibonacci areas, it's even more powerful. Ultimately, this termination, we're looking at the triggers on the large. Remember, Haji? Large chart leads the way. Large chart defines direction with the color. Large chart defines momentum with the trigger lines. And then large chart is going to define the areas. It's going to show you the area in question. And your trigger line location is going to let you know whether or not you should be trading into it or from it. Does that make sense? So we haven't even ventured off of the large chart yet. We could have our small chart minimized, hanging in the background, doing something. It's irrelevant until the rules are met. I want you guys to see when this termination, large triggers go from green to red. Small triggers give you odds favorable momentum. We've started the process of looking for a trade. This bar has not reached Fibonacci support. Price has not reached an area. I do have odds favorable momentum. And guys, look at that. There's that tail. This is where you're going to be able to pinpoint on that smaller chart where the market is most likely to continue. This is going to become your entry for the highest probability trend trade, guys, for the absolute best of the best. For that trade that typically wins 70 to 80% of the time. And guys, this is going to be the basis of your plan as a brand new user, is being patient, allowing that 90% to happen so that you can capitalize on the 10% when the advantages are met. And this last picture here shows you really how powerful fibs can be. And I like this picture. It's my favorite picture that I share in the classroom. Because even with odds favorable momentum, guys, everything is absolutely screaming to the downside. Momentum is its best. The sellers are in control. And then it reaches these yellow 1-to-1s. And when it reaches that area, whoops, you guys ask yourself, where are my trigger lines? Every one of them, even with the momentum, remains above these 1-to-1s. Let's sit on our hands and see what happens. Let's not trade into those 1-to-1s, hoping that it breaks. Because at this point, it doesn't even have the potential. The small triggers haven't broken. Nothing is broken. And then we get into just how powerful fibs can be, how fights happen, how decisions are made. The buyers push hard right off of that area. Notice that they reach Fibonacci resistance. All of my triggers remain below. There's nothing for you guys to do. No shorts, no longs. The small triggers come up, but the large triggers stay down. That indecision can't have momentum. I'm still in a holding pattern. Everything is below resistance. And guys, the fight carries on for about 25 minutes. Buyers and sellers, buyers and sellers, buyers and sellers. And they're just duking it out, and they're fighting for supremacy, right? There's your 90%. 90% of doing nothing. 90% of staying safe. 90% of keeping the powder dry, not giving it away when the advantages aren't present. Well, ultimately, everything breaks above resistance, small and large. The path is now clear, and it's coupled with that odds favorable momentum. And there's your tail, guys, circled right there. There's your potential entry for the highest probability trend trade that you can take. The high probability trend trade that happens after this is your best of the best. So Haji, remember when I said we don't trade these tails, right? We're not trading the tails because by the time this tail forms, man, that market is gone. It is gone. That's why we use the refinement chart. That's why we use that smaller, faster chart, because we're going to be able to take this one tail, right? And remember that tail is the pullback on the small chart. We're going to pinpoint on the refinement chart where the tail is likely to happen. These tails become a study tool for you. When you have odds favorable momentum and you have one of these tails, you're going to get in the habit of circling it. And when you come back and you have that momentum and you have one of these tails, you're just going to get in the habit of circling it. And then you're going to see, where do those circles show up on a smaller chart? This is where your entry comes from. But what the perfect entry looks like is nothing more than a little tail on the large chart. So great question. Large chart's going to lead the way. Yeah, this is how you're going to go back and try and prove me wrong, to prove that I'm full of beans, that this stuff is nonsense. And I want you to do that. I want you to put that much effort into it. But the large chart just gave us direction, guys, and the large chart gave us momentum. And the large chart is where we're going to define those areas, where we're going to define our potential trouble spots, and we can let them clear, we can let them not clear. And what you're going to find is that the large chart is 90% of your day. Until the large chart says that the momentum is there and the path is clear, you don't need a small chart. You're not looking for an entry. Is everybody okay with the simple recipe? Price reaches, no triggers, no trade. Small and large get to the other side. Now the path is clear, guys. That is the absolute most basic form. For the brand new users, I want you to keep it that simple. I want you to just let it be broken or let it not be broken. Even on this picture, check it out. Odds favorable. There's your tail. Happens all the time. Every market, stocks, futures. Use it for your options. Hedge your soybeans, whatever. We're just trading patterns. But there is one more termination condition that doesn't require areas. Notice that I said that areas on the large chart can be a termination. Areas on the large chart are used to determine whether or not it's likely to hold or likely to break. Sometimes that large chart's going to turn from the middle of nowhere. Sometimes that large chart is going to have odds favorable momentum and a clear path, and everything looks perfect. But there's one termination on a small chart that's going to help you. Hey, good morning, Miss Debbie. Understand and be able to see change that the large chart can't tell you. And that final termination happens on the small chart first. And this is the only termination condition on a small chart, guys. We're going to use the lines on a small chart for entries. We're not going to be scared of lines on a small chart. The large chart defines the areas that are problematic. But on a small chart, if you get 3 losses of momentum, 3 divergences in the same price range, it may terminate the trend. 3 losses of momentum in the same price range, 3 divergences, it can stop a market that's moving down or moving up. And you're going to see it because the cyan line is going to print. And all the cyan line means is that momentum didn't follow price. Price cranked down, went up, and created a pivot. When the indicator in the background, using those MACD-BBs, runs its calculation and momentum doesn't follow, you're going to get that negative number, which means absolutely nothing. It's a byproduct of the mathematics. But this cyan line is going to print, and it's going to let you know that there's a loss of momentum. And when you get it 3 times, well, that downtrend may be over, or it may just create a push that is beyond your best of the best entry. So 3 divergences in the same price range may terminate the trend on a small chart. 1 divergence, hell, that might just push you back to your best entry. We don't let 1 divergence scare us. 2 divergences, we'll get our guard up, but that may push you back to your best entry. But that 3rd divergence lets you know that, all right, change is probably happening. And it becomes even more prominent when your small triggers work their way inside of the large triggers, giving you that weekend anything can happen trigger look. And more powerful still, when the 3rd divergence that prints is higher than the previous from a low or lower than the previous from a high. That's a head and shoulders pattern. So 3 on their own is a big red flag. 3 with weak triggers is a bigger red flag. And then 3 with that head and shoulders is the biggest red flag. No more short trades. Or even better, if you entered the market where it was most likely to continue, these 3 divergences tell you that it's time to cut ties with that trade, to not wish and hope and want and all that good stuff. Just take some money, get out, wait for the next best opportunity. And you're going to see this look at a low and this look at a high times when your large chart may be turning from nowhere. It appears to be because it's such a slow moving chart. 3 divergences at a high keep you from taking that last long, and 3 divergences at a low keep you from taking that next short. And guys, those are your termination conditions. Your large chart is going to define the areas, the lines that may stop the market. The only termination condition that I give any credit on a small chart is 3 divergences. That's it. So the large charts led the way, guys. We have direction. The background is green. We have momentum. The smalls are above the large are wide. They're angled in the direction of the trend. Notice how I'm getting all of this from the most current bar. And it is defined areas. Price has not reached Fibonacci resistance. Therefore, that's a target. That's not a termination. And all of my triggers are above the former resistance. It's now behaving as support. My path is clear. Is everybody, give me a Y in the room if you're with me. The large chart says, let's look for an entry. The large chart dictates. So now, with momentum and a clear path, we're going to turn our attention to that refinement chart. We are going to look at this chart, and we're literally going to take the 1 bar on the large chart, and we're going to break it down into 15 to 30 bars on that smaller, faster chart. This is your refinement process. So, Haji, This is where your tail happens. The bottom of this bar is the beginning of your pullback on a smaller chart. The top of this bar, the tail, in this case, happens to be a pullback to an area inside of favorable large triggers. This is your entry, Haji, right here at this midband, right where the top of this tail. And with this refinement process, we can reduce our risk and we can maximize our profit potential. So we're going to talk about the verbiage on the rules. And I think what you're going to find is that it's very specific. Rule number 3 is very specific. We're going to use a limit order. We're going to literally let the market come back to us. Hey, Miss Cindy, nice to see you posting. I was afraid you couldn't hear me. You're so quiet. We're going to use a limit order. We're going to wait for the market to come to us. And when we're waiting, we're going to wait at an area. We're going to wait at fibs, midbands, yellow 1-to-1s. We're going to use the lines on a small chart for entry. Similar way that we use the lines on a large chart for terminations. But we're going to use a limit order, and we're going to buy or sell a pullback. We're going to let the small crowd do their thing and push us back to the best of the best. And we're going to make sure that that pullback is in an area, fibs, midbands, yellow 1-to-1s. And here's the key, guys. We want that area to be inside what we call favorable large triggers. And favorable large triggers for the new user create the least amount of risk. Favorable large triggers for the new user are going to help you create the highest profit potential. And favorable large triggers simply means that your large triggers on the small chart, as well as the synthetic triggers on your small chart, and the synthetics are nothing more than the large triggers from the large chart. It means that they're one on top of the other. It means that they're overlapping. It means that they are so compressed with one another that it's going to create the smallest possible area window for these areas to be inside of them. The bigger the spread, the more potential bounce points. So by having these favorable large triggers, it will create the absolute smallest potential entry point. And the smallest potential entry point is going to create the smallest risk. And then Haji, we're going to talk about entry rules real quick, and then I'm going to answer your question. Sound good? But you raise a great point, which is why I want to do it after we talk about it. Guys, here's your look on the small chart when the large chart says go. When the large chart had that odds favorable momentum and the large chart had a clear path and everything on the large chart said it's time to look for an entry. That's your look on the small chart. You should have odds favorable momentum. You're going to start eyeballing those trigger lines. Are they favorable? Are they wide, angled to the direction of the trend? Are the large and the synthetic overlapping? If they are, man, that's a bonus. And you're also going to look, what are the areas that may fall within them? So Haji, these trigger lines are nothing more than moving averages. So as the market pushes up, so are the trigger lines, right? So if an area is a little bit above them, they're going to get swallowed. But if an area is a little bit below them, well, they're on the wrong side of the correction, right? Price loves to correct back to these trigger lines. That's why we bury these lines inside of them for the perfect entry. But we have to let the small crowd do their thing. So when everything says up, when the path is clear, the momentum is the strongest, guys, you're going to let the small crowd force a pullback. And it begins with the reversal bar on the smaller chart. And this reversal bar says, hey, small crowd's fighting. And guys, this is where we get hopeful that they at least fight enough to get us to an area. You're going to create a window of opportunity when this reversal bar prints. And you are going to look at your favorable large triggers in the areas that are falling within them. And your window of opportunity for a long trade is going to extend from the highest point of support, right here in the 79.20 range, all the way to your lowest form of support, these yellow 1-to-1s down here at the 79.09-ish range. And the areas inside of favorable large triggers, and I want you to get in the habit of saying that every time you take an entry, writing it on your chart. Every time you take an entry, it's going to help you. And absolutely. So Tony, we are looking for midbands, fibs, yellow 1-to-1s inside of favorable large triggers. And you're going to see that it creates a window, not 1 point. But you're going to activate a limit order at the top of the window. And why are we doing that? Why is it at the top of the window? Because the large chart said odds favorable momentum. The large chart said there's nothing in the way. This large chart is the bullet train screaming to the upside. So we don't expect that small crowd to get too much work done, right? So we're just going to activate at the top of the window. We're going to make sure that we don't trip over our pennies to try and save a few dollars. And if they come back and they reach your limit order, guys, you're in a trade. You're in a long trade with the advantage of momentum, with a clear path. And now you've just entered the market where the market is most likely to continue. So I want to go through the process in this picture one more time. Large chart said odds favorable momentum to the upside. Large chart said clear path. And guys, I'm going to write this on here. Large chart leads the way. Don't let the small chart fool you into trades when the advantages aren't present. But then on the small chart, the fight begins. There's your reversal bar. At the time of the reversal bar, you're going to circle from the top trigger line to the bottom trigger line. This is not the window. This is where we're looking for those areas. This is where we're looking for those fibs, mid-bands, yellow 1-to-1s. Your window of opportunity extends from the highest point of support to the lowest point of support inside of favorable large triggers. And this is the area where the market is most likely to bounce, most likely to continue. Guys, rule number 3 gets you in. This is where the bottom of that tail, Haji, is most likely to form. And if price chooses to come all the way back to the top of that window, you're in a long position. And now let's talk about some of the realities of trading. It may go to the next level. You're still in the window of opportunity, guys. Don't panic. Don't let red numbers scare you. It goes to the next level of support. Don't panic. You're still in the window. All the way down to those yellow 1-to-1s, guys. You're still in the window. We enter at the top because we don't want all that momentum on the large chart to have us missing out, right? We're okay with a little drawdown in the trade. It's totally normal. And the cool thing about knowing where the market is likely to continue is we know where it shouldn't go. And that's where our protective stop goes, outside of that window of opportunity, 4 or 5 ticks below it for a long. And what you're simply saying is that if this is part of my 20 to 30%, if this is one of those trades that isn't going to do what it typically does, I don't want to be in it. If it goes beyond that window, I'm going to let it hit my stop, and I'm going to take a small loser. We're going to manage the risk. And guys, anything that wins 80 has to lose 20, right? Anything that wins 70 has to lose 30. And small losses are a normal part of a positive equity curve. I don't think I've ever had a day with my goals met where I didn't take losses. And why is that, Haji? Because these are moving averages, and price loves to correct to the average. And when there is a solid bounce point inside, these behave very much like a brick wall throwing a tennis ball against it. And if it goes beyond the window, well, we're beyond that correction point. We're beyond those ricochet points. We just don't want to be in the trade anymore. But the cool thing is you guys are going to spend your first 20 days with me, your first 20 days with Nexgen on that simulator every time. And all I want you to do is get in the habit of trusting. Just trust that this is your best chance of success. Just trust that this is your perfect entry, that this is the entry that you never want to miss no matter what. Because that's the entry, guys, that 70 to 80% of the time takes you off to the promised land, gets you to that profit target, gets you in a position where you're winning more than you're losing. You're creating confidence through the memory of success. And because you wait for the market to pull all the way back, your risk is reduced, guys. If you get that silly little fear of missing out that we all get, myself included, and you hop in at the top of this bar because you're afraid that it's going without you, the only thing that you've done is you have drastically increased the amount of risk on this trade. And that doesn't guarantee you a winner. What it guarantees you is a bigger loser if this is part of your 20%. The other thing that you've done is if you jump in early, is you've minimized your profit potential. You've cut it short drastically. So we're developing trust on the perfect entry, guys, because the perfect entry creates very manageable trades. The other thing that you can do, we know where the stop should go. We know where the market shouldn't go. But once it starts to do what it's supposed to do, once it embraces that odds favorable momentum, that clear path, and it starts going in the direction of all of it, you can take your stop and put it a couple ticks below that reversal bar. We can minimize risk before we ever take profits. And this is a key part of what we do, guys. This window of opportunity gives you the ability to minimize risk and maximize profit potential. Thanks, Tater Bear. And then one of the other common things, and I want you to see this. Remember that your small chart is a smaller, faster chart. It's a refinement chart. Hey, Jose. More often than not, ladies and gentlemen, the small triggers are going to turn against you on your smaller, faster chart. This is one of the reasons why I say a million times a day that momentum is established on the large chart. Guys, we love a little loss of momentum on a small chart. It's what gets us to our best entries, right? Notice that they're still outside. They're still odds favorable, but they've turned against. That's totally cool. No worries at all. It happens. And guys, this is your best of the best entry. This is your three rules coming together on two charts, giving you the three advantages, getting you into the market where you now have a trade. And all you need to do is focus on your first couple weeks of finding the trade. And then Haji, here's your visual. This is after the fact, guys. This is historical. This is how you can study. When you have strong trigger lines and no terminations on that large chart, rules 1 and 2 are met, scroll back, circle a tail. If that circle, or in this case a square, shows up in an area of support inside of favorable large triggers, you know that you have a high probability trend trade. You know that the rules are met. And the cool thing is this is your best look, right? This is the trade that typically wins 70 to 80% of the time. This is the trade that creates confidence through the memory of success. Take a picture of this trade. Drop it into your spreadsheet. This is what it's going to take to get me in the market, right? That tail, that entry. That's as good as it gets. And let's look at one that's not straight from it. This one is a great long, it says. There's your tail. There's your pullback to support inside of favorable large triggers. And what you're going to find is that the more times you go back and circle these tails and find those perfect entries, the easier it becomes to catch them in a market that's moving. High probability trend trade short. Odds favorable. And notice how that limit order is waiting just below the area inside of favorable large triggers. Somebody showed us this picture and they said, Mark, I am so confident in this methodology that I will wait for the market to come up to me. I'll wait for the market to come to my limit order. I'm not going to chase price because I know exactly where the market is likely to continue. And guys, I'm telling you, trust is what we're building right now. Trust is exactly what we're looking for. And then, Haji, I want to answer your question. When we talk about the window of opportunity inside of favorable large triggers, the areas that fall beyond those large triggers, guys, those aren't our areas because this is so far beyond the correction point. We just don't want it. It can't be a high probability trend trade. So when you see areas beyond those triggers, just understand that's not yours. That's not what you're looking for. And the same thing is true. I've got quite a few. Guys, I love pictures. I think pictures set the tone. Reversal bar prints, right? Limit goes below the window. And then all of these areas up here are beyond that top of the trigger line. All of these areas are beyond the correction point, guys. They're not in my window of opportunity. These are not part of the high probability trend trade scenario. And this isn't based on hopes and wishes, guys. This is based on decades of study. This is based on understanding these patterns because that's all we're trading is patterns. These patterns don't know if I'm trading crude oil. These patterns don't know if I'm trading the S&P. These patterns don't know if I'm trading the NASDAQ. But the patterns repeat themselves. The market corrects themselves. And what you're going to find is that very often when you circle a tail, there's your pullback to resistance right inside of the trigger line, right there, guys. And it happens over and over and over, and not as much when the market is holiday trading, but look at this one. And this was at 5:16 in the morning. So you may not have been up yet. Come on. There's your pullback, there's your mid-band, just inside of favorable large triggers, guys. So we're not using the circles. We're not trading the tails. What we are trading is pullbacks to areas inside of favorable large triggers. Do you see it? And guys, this is one of those 50-50 trades. The small triggers have smashed. The large triggers are lagging. And then on my small chart, and guys, this is the perfect entry. I have strong triggers. I don't have divergence, no loss of momentum. And look at your window of opportunity, guys. It is one line. It is minimal risk, and it is maximum profit potential. You're going to be able to pinpoint where that tail is most likely to continue. You're going to be able to pinpoint the most likely spot for continuation, guys. And this is your high probability trend trade. This is your first 20 days with me. This is you making sure that you understand. Odds favorable momentum. Smalls have smashed, large have not. Reversal bar is printed. Guys, we can pinpoint where the market is likely to continue should it decide to pull back. It doesn't guarantee a winner. But that's the point. If this market's going to continue up from this termination, if this market's going to continue up with this odds favorable momentum, this is the highest probability spot between 62 and 58. There is a 4-tick window of opportunity. The only thing that I'm not in control of is whether or not it comes back to it, guys. That's the only thing that I'm not in control of. I can do all the research, I can do all the analysis, but I can't make them come back and get me. Are there any questions about the high probability trend trade? Are there any questions? That's NASDAQ. Look at that. 1, 2, 3 divergences, and look how high it pushed beyond the window. Isn't that crazy? You guys knew that if you got in on the first divergence, stayed in on the second divergence, on that third divergence, maybe it was time to cut ties. Pull back to a mid-band inside of favorable large triggers, guys, over and over. It's amazing how often this happens. It really is. Learn how to catch the entries, guys. Learn how to catch the best entries, because when you catch the best entries, they become manageable trades. So here's a little something to help. This is a high probability trend trade checklist. Print this out, put it on your desktop. Start writing these rules on your chart. When your rules are met, when you have a good top or bottom, a termination that creates a full reversal, write it on your picture. When you have odds favorable momentum, write it on your picture. Write those words, strong triggers, point to them. No terminations, point to your clear path on your annotations. Area inside of favorable large triggers. Use the language so that you can catch the best entry, guys. If you print this out and put it on your desktop, you're going to begin to police yourself. If you write these rules on the chart, you will never have to ask, hey, Mark, was this a good trade? You'll be able to say, hey, Mark, I had every rule met. Am I understanding them correctly? And then we'll have a conversation about everything you do. I'm also giving you, for you visual people, here's a good bottom, strong bottom, termination that creates a full reversal. There's your odds favorable momentum, and I even added in what it means when the triggers go weak, that crapshoot, that donkey off to market. Here's a termination, here's a broken area, here's the potential to break for that medium probability trade. And then there's your windows, guys. So Haji, once again, reminding you that outside of the window isn't your best bet. And guys, on that same token, if you're a tick or two above those triggers, you're cool. You got a bounce point before the correction, a tick or two above, right? Don't split hairs, because you're still in the correction zone very much. Guys, this one, put it on your computer. Study it each morning. This is what I'm looking for. And then piece it together so that you can take the absolute best trades. And then finally, you're going to want to have a plan, guys. You're going to want a plan that says this is when it's time to get into the market. I'm going to give you a plan as well. And this is a stepping stone in your journey, guys. This is keeping you focused on the highest probability, the highest chance of success, optimizing your chances. Because every time you win a trade, you get a little more confident. You build a little more trust. Every time you get paid, you feel better about the methodology and you become more focused on adhering to the rules. So this stepping stone is going to optimize your chances of success with a 50-50 trade and that high probability trend trade. Guys, it's going to be your simulation and your study. You got to study. Your class feedback from posting in the room and your continuous practice, you're going to create your plan. And your plan is going to revolve around your ability to read indicators. But this keeps you focused on becoming a chart reader until you're able to develop your plan. And your simple plan, it starts with never fight the large chart direction, guys. Never fight the large chart triggers. If you can commit to that wholeheartedly, it's going to eliminate probably 60%, 70% of the mistakes that new users typically make. And remember, the goal is to get paid. The goal isn't to look cool, to show off. The goal is to get money in the account. So that's what this does. This entry, your mechanical checklist-based entry, puts you into the market at the best spot. This should be your focus for 20 days, guys. Making sure that you can take that rules-based entry. And then once you take it, that's where the fun starts. That's where management comes in. Every great entry creates a manageable trade. And what we found is that a very mechanical if-then scenario for your management gives the new user the best chance of success because you're learning to read your charts. And being a chart reader is what's going to allow you to manage ultimately. And there's that magic phrase again. You will craft a plan tailored to your personal goals based on your experience reading the indicators. Your management plan will change dramatically from this very basic approach to where you end up, because you're going to be able to understand momentum and where the market is likely to go. And that's really going to set the tone. But your management plan is based on the large chart leading the way. Your management plan is based on odds favorable momentum and a clear path. And let's go through this. And this is in the spreadsheet that I gave you. Odds favorable momentum, clear path. There's your reversal bar. You create your window of opportunity, right? Inside of favorable large triggers. You activate your limit order and you wait for the market to come up to you. And when it does, you're in a high probability trend trade short. You have every advantage. So your management plan, this is the first picture of the management plan, it revolves around that beautiful entry. Right there at favorable large triggers, right there at the area, giving you that bounce point. And your initial stop goes outside of the window. It goes where the market shouldn't. And your ATM strategy is preset into NinjaTrader for you. For something like crude oil or the S&P, they're set at 12 ticks. Guys, 12 ticks gives you reaction time to put your stop where the market shouldn't go. 12 ticks is not the magic number that they'll never hit. 12 ticks is nothing more than giving you time to get to the correct spot. And one of two things are going to happen here. It's either going to go up and it's going to hit your stop. And if it does, that's cool. Normal part of a positive equity curve. Losses are a part of it, guys. That's part of your 20%. It's a cost of doing business. Or it's going to push in the direction of momentum, in the direction of a clear path. It's going to give you that reversal bar in the direction of the trade. If I get a reversal bar in the direction of the trade, then my stop gets moved 2 ticks above it. This is my new stop. This is the only thing that I have to do, guys. My first one was where the market shouldn't go. My hands are up. It either gets stopped out or I get a reversal bar. I adjust my stop to where the market shouldn't go, and my hands are up again. And there's only two things that are going to happen. It's either going to hit my stop. It's a smaller stop. It's a smaller loss. And you'll find very often that your losses are much smaller than your winners. Or with all that momentum and a clear path, it's going to hit your first target. In this KISS plan, in this very pragmatic, methodical, emotionless plan, your first target's $100, guys. Your first target is not a lot of money, but $100 creates confidence. $100 feels good, like that serotonin kicks in, that dopamine kicks in. I just got paid. And when you get paid, it feels good. You start to trust things. You start to trust entries. You start to trust momentum. You start to trust that the large chart got you into it. And you're also going to move your stop to break even. So now not only did you get paid, but you also have zero risk on the trade. I mean, none. So it allows you to remember that the large chart told you to take that entry. The large chart was screaming down. The large chart had nothing in the way. And it makes it easier for you to hold for that second target. You're going to get stopped out break even a lot, guys, and your plan will change to where that break even goes away. But with all that momentum, all that direction, all that clear path, it's not too terribly difficult to get to only $200 on a second target. But the cool thing is even though that's only $200 from your entry, that's a $300 trade. You already took $100, you went break even, You just took another. And guys, that's a $300 trade. It's only $150 per contract. But $300 a day, guys, creates a $1,500 week. And a $1,500 week translates to a $6,000 month, and that takes you to a $72,000 year. And I don't know about you guys, but I wouldn't be upset about an extra 72 grand a year. I could find something to do with it, right? And this is the goal. The goal is that everything is manageable. Everything is pragmatic. Everything becomes emotionless. You stop worrying about the results of your trades and you start focusing on the execution, because it's the execution, it's the entry that has been proven to win more than it loses. It creates a statistical advantage. So I'm going to drop this KISS plan into the room, guys. You're not obligated to follow it. If you're not winning consistently, you might want to give it a try. That's totally up to you. But what you're going to find is you're going to start to deviate. You're going to start to make up these rules where you say, well, there was a blue line here, I'm not taking it. And you're going to forget that only the large chart defines areas. And you're going to say, well, my small trigger's turned against me. And you're going to forget that the large chart defines your momentum. Your small chart is nothing more than an opportunity to take advantage of what the large chart has done. And in this case, the large chart said don't go short into 17,104. Does everybody see it? Price reached Fibonacci support and not one freaking trigger makes it through. And look where it is now. Isn't that awesome? Not one of you got caught in that trade. Price reached resistance and not one trigger line went through. None of you tried to go long into that red line, and you don't have momentum, so none of you tried the short. You're saying, man, let me sit on my hands and let me see what that S&P wants to do. And then it took it a while, but sure enough, it bounced right off of support. If you got in at 63, your stop is 2 ticks below that reversal bar. And it's a medium probability trade. It's not a high probability trend trade because the large triggers still haven't cleared it. But if all that momentum carries it up, doesn't it make sense that it may go to 73.85, to that next key area above me? 63 entry, and your stop is about 58, guys. That's $50. Does everybody see it? Guys, we called this 12 minutes ago. 12 minutes ago, we knew where the market was likely to continue. It's not a guarantee win, but if you can nail this entry, guys, life is good for you. Awesome. So that's the first hour and 17 minutes, guys. The second hour is going to be chart reading. The second hour is going to be reading your charts, looking at the live market, talking about advantages. I do not call trades. I do not tell you when to get in. I do not tell you when to get out. What I do is my job is to teach you to read indicators. My job is to teach you to recognize advantages so that you can make intelligent decisions. So when you post a chart in the room, guys, do me a favor. Tell me why you did what you did. Use those key words: momentum, clear path, entry area. It doesn't matter to me whether you take a 50-50 or a high probability trend trade or an HVA trade or a momentum trade or an edge trade or a counter trend trade or thinking that you have a gap theory trade. It doesn't matter. Tell me why you did what you did. We'll make sure that you're doing it to your best of your ability. Same thing with entries. Tell me where you got in, why you got in there. We'll make sure. Please, tape bearer, post all day. You don't ever have to ask permission. But the second hour, when I look at charts, guys, I start at the top and then I scroll down. So if you're number 10 in the lineup, you'll be number 10. The second you post it, I'm probably not going to look at it because there's other people that posted before you, and I want to keep it fair like that. The flip side of that, and the exception to every rule, guys, is if you have to go to work, if you have to leave my classroom early and you need feedback sooner so that you don't miss it, all you have to do is say the word, hey, Mark, I'm going to post a chart right now. I've got to be in the car on my way to work in 10 minutes. Can we talk about it real fast? And I'm always going to say yes. But remember to give me the best opportunity to give you feedback, guys. We learned the rules. You're going to simulate, post in the room. We simplified. Let's start taking pictures so we learn the looks. I'm going to leave you guys with crude oil. 63. I'll check it out. You guys already hit $100. Nice job. You don't have any risk on the trade. Outstanding, ladies and gentlemen. Look at you guys. You didn't know you had it in you, but you did. When I come back, I'm going to start clicking on charts. I'm going to start looking at the market. Guys, go stretch your legs. Go put your hands in the air, touch your toes, whatever. Don't sit in the chair for 7 hours. It can't be good for the body. I'll be back in about 5 minutes, guys. Post them if you got them. Gentlemen, let's get back to the good stuff. So, second hour starts. I just want you guys to see it. Whoops. I have to scroll. I hope you can see that. I have to scroll like this to get you guys to get to your pictures. So, do me a favor. If for some reason I miss a picture, if I accidentally skip over something, it's okay to go, dude, Mark, you missed it. Because I will. I will make mistakes, guys. I will have challenges every now and then. Part of being human. But I'm going to scroll up to the top. And we're going to take a look and see where we're at. And then Jim N., you posted this one yesterday after class, so I wanted to make sure that we talked about it. Hopefully you're in here. And I posted a picture in the room in response, but I really want to talk about a couple different things on here because there's some great lessons in this picture. And I think that there's some really good opportunities for learning here. So I'm going to take a picture of your picture because you referenced the gap theory. And guys, let's do a quick gap theory lesson. This is what's fun for me when we get to talk about this. Gap theory is a large chart termination finder, really. And the gap theory says that when price pulls away from the large triggers, the synthetic triggers on the large chart, so large triggers and price separate rapidly. And then it hits an area, whether it's a mid-band or Fibonacci, price tends to snap back to the triggers. And this is called the gap theory. And you'll see it happen a lot. So much so that we've got a little bit of we've got a rule behind it. I'm going to show you what it looks like a couple times on a live market, or at least historically in a market. See if we can find an instance. Price comes up, hits Fibonacci, large triggers are about a full bar away. Price is likely to close that gap. And this one's ideal. Comes right off of a termination condition. And it comes up to, well, multiple levels of resistance in the mid-band. And guys, do you see how the large triggers stay down? Do you see how the large triggers, there was room for an entire reversal bar before price ever hit them? This is the gap theory. And this is a pattern that repeats itself. It happens very often. There it is again. Price comes down, accelerates rapidly. There were mid-bands and fibs. The large triggers don't follow, and sure enough, price comes up and closes the gap to them. Over and over, you're going to see this. There it is again, right off of a mid-band. But this gap theory is an awesome tool, and not so much to take a trade. Not yet. But it's a great way to gauge when it's too soon to take the next trade. When it's too soon, for example, to take a short, even with odds favorable momentum and everything says down, price reaches this mid-band and the large triggers remain above the reversal bar marker. They're a full bar away. This is a big safeguard for me. Don't go short, don't go short, don't go short. It may close that gap. It may suck right back up like a vacuum to those triggers. You see it here. Price accelerates away. It hits these key areas. The large triggers are unable to follow. The anticipation is that even though we're coming from a great termination condition, I'm not looking for that long trade yet because it's likely to close the gap. Guys, this is from March on the S&P earlier. I want you to see what we just looked at. We saw the exact same picture from today's market, I believe. Where are those one-to-ones? Right back to the mid-band. Large triggers don't follow. Gap gets closed. Looks darn near. Whoops. Like this one. Same concept. So it's a pattern that repeats itself. And this gap theory happens all the time. And it may close the gap back to those triggers. And what you'll also find is it may close the gap and then just continue in the direction of the trend. So it doesn't say go short. It just says, hey, or it says don't go short yet, right? Don't do that. Not yet. Let's wait and see what's going to happen. Let's see if the gap gets closed. And then what you're going to find is that you'll be able to use it as a tool eventually, maybe to trade with that gap theory, trading back to those large triggers. So there's the little lesson coming off of it. And then, Jim, I hope you're in here. So you placed a buy order after using the gap theory, which I'm assuming means that you're expecting it to pull back, right? So you end up going long at the triggers, which is cool. You didn't go long yet. You let it pull back. But you'll note, and there's a couple different things that I see here. First, I don't have any areas to trade from, right? You're just using those triggers and that gap theory, and you're expecting it to go back up off of them. But the reality is you just came off of all of these areas, 4 areas of resistance, every trigger line below it. And sure enough, it did close the gap. So not going long up here was brilliant. But you don't really have the information to go long yet here. The larger down, the smaller up, but you've got 4 termination conditions above you. Does that make sense? All of these say not yet. You took it from the absolute best spot, though. If you were going to trust this good bottom, you took it from the perfect spot, closing the gap back to the triggers. So I want to celebrate some great chart reading going with it. Absolutely. And man, where you did it is brilliant, Jim. It really is. And then I want you to see what happens. Price comes right back to Fibonacci resistance, that lowest point of resistance, right? And your large triggers still aren't moving, and your small triggers are still down, and your large triggers are all below it. Everything is below that area. Did you 2 contracts and take half off right there? Brilliant trade. And this is where I guess what I wanted to really say here is that with these large triggers not blinking, with everything still below, it's all right to just get paid. That's a huge trouble spot. And even if you wanted to try to let one run, this divergence from the line with everything below and the large triggers still down, yeah, there's no reason to get out break even on that one. Break even's good, but this is just recognizing trouble. If you're gonna take the long in determinations, if you're gonna take the long on the gap theory, identify your trouble spots, and it's okay to get paid there. Because could you imagine 2 contracts? That's a quick 220, right? And then it continues down with the large triggers. And it's that dance. It's that support to resistance, to support to resistance, to triggers, to resistance. And you're getting caught up in that fight a little bit. But you did it beautifully. You did it from the right spot. And that's what chart reading will do for you guys, is you'll be able to take these lower probability trades from the correct spot, and you'll be able to take those quick profits. So Jim, nice job. And thank you for opening the door for the lesson on the gap theory there, because it's an important one. It happens all the time. And that's a great thing to talk about in the room. All right, who's next? Not a lot of pictures being posted today. Cav posting in. And guys, you'll get to the point to where I'm going to know what you're thinking without having to read your charts. Nothing in the way to the upside. Took 2 trades, reached your target on the first, took 5 ticks before the second. So guys, what Cav has done here, let me show you a small chart, is with momentum, as the area breaks, he takes what's called a momentum style trade, a little breakthrough stab back, and takes quick profits. And everything about this is revolving around momentum and a clear path. And then when he clears the second spot, he does it again, and he just takes these little chunks out of the market with momentum. Remember I said momentum, guys, is key. Momentum makes things happen. Momentum pushes the market. Momentum breaks areas. And this is just showing one of the ways that you can capitalize on that great momentum without it having to be a high probability trend trade. Cav, nice work. All right, E. Webster, 911. Not high probability trigger with triggers inside. I agree. But you had room to the target. Entered at the top of the box. And then two divergences. You get out behind. Cool. So let's break this one down a little bit, Webster. And I like it. And I like that you said maybe wait lower, right? Why do we get in at the top of the box? Because of odds favorable momentum. And I think that's a big key, guys. With odds favorable momentum, we get in at the top of the box. We don't want to miss it. We don't expect that small crowd to do much. But what happens here? You've got those weaker triggers, absolutely, but the path is clear. And then we've also got a divergence. We've got that loss of momentum. So I agree 100%. Bottom of the window for me makes more sense. Does that make sense, E? Top of the box is for when it's perfect, right? It makes sense to go a little lower. And then what that does is it gives you room to your trouble spot. What's your trouble spot? That divergence high. Because I've got weak triggers, you get in at the best spot, you've got virtually no risk, and when you get back up here, you're already up 100 plus. And then that second divergence with the weak triggers, notice that none of your areas are really inside of favorable large triggers anymore. The small chart is showing you the change. So I think that you did this one well. 62 to 72, you made $100. And then you didn't lose anything. Beautiful. Taking a medium probability scenario and managing aggressively. That's how you got to do it, right? That's what needs to be done. If you don't have the best momentum, you've got to be able to manage assertively. You've got to be willing to not hold for a home run when your indicators are telling you that it's not a home run hold, if that makes sense. And the only way to start recognizing those home run holds is to continually take pictures, to talk through it, to make sure, and to get feedback. Really, great job, E. Webster. And then, all right, Tater Bear. I'm thinking this could be one. We are bouncing off of the 1-to-1 and have a clear path to 1710 or 17100. Stop loss, enter profit target. All right. So let's go through it. What do you say? Tater Bear, I'm going to tell you guys right now, I'm going to become this thorn in your side that every time you post and say, I think this could have been one, I'm going to go right back to advantages. All right. I'm going to go back to advantages. So Tater Bear, identify. Did you have a good top or a bad top? Right? Write it on the chart, because why are we annotating charts, guys? We're not annotating charts because I'm trying to give you busy work. What we're doing is we're trying to gauge advantages, because trades come from advantages. So this one in particular is a good top. That's a termination that creates a full reversal, right? And then the next thing that we're looking for, we know the market's going down. We'll just put a down arrow. I know it's going down. I'm only looking for shorts. And then on the entry bar, what you want to ask yourself every time you take a trade, Tater Bear, did I have odds favorable momentum, or did I have weak triggers, or were they kind of, in this one I'm going to say, are they in between? And on this one, we don't have the best of the best look, right? But we're not weak. So we're kind of at that, I'm losing momentum, but I still have it. So I'm going to call that in between. Is that cool? Are you comfortable with that one? Awesome. And then I have to talk about my path. I've got a giant blue fib, right? How many trigger lines have broken through that blue fib? Okay, and I agree with you 100%. So no triggers through fib. Do I have a clear path, or do I have no clear path? What do you think, Tater Bear? And I'm doing this annotation process, guys, because this is the exact same process that if you get in the habit of doing it as you're reading, as you're looking, it's going to help a lot. So I have no clear path. So when I look at it, I don't have the best trigger look, and I don't have a clear path. And then Tater Bear, do you remember this one from yesterday? 3 divergences and same price range. Is a termination, right? So I have terminations, large chart, small chart. I don't have the best momentum. And what does it take to break areas? Typically, we're looking for that odds favorable momentum, that really, really great look. I've got termination, meh, triggers. Where would your entry be? Would you enter here? Or here? Would you enter here? Or here? Or here? Or do you just kind of have to say sometimes, and this is where my head goes, and guys, I don't tell you what trades to take or what trades not to take. I have given up both large chart advantages. Have a small chart term. Is it possible? This isn't my money. You would have entered on the second or third failure, right? And do you say that because that's when it went down? Because hindsight's 2020? Or do you have a plan because the second or third failure, you had 3 divergences? I don't know what you're considering a failure. But the idea, Tater Bear, is that you want to have advantages, that you want to go through. And it's easy to circle a spot, right? Before the 4th arrow. So right here. And then when you got divergence from here, and it printed right here, would you have exited? Or would you have said, with in-between triggers and no clear path, to hell with 3 divergences. I'm going to hold on because my crystal ball says that it's going to go down to Fibonacci support. You would have held because it didn't hit your stop loss. Okay, well then congratulations, great trade. I want to see something. Easy to say hindsight, right? And 2 divergences on a 50-50, you would have let it hit your stop loss, right? And maybe crude oil. 3 divergences, you would have let it hit your stop loss. So the idea here, I guess, and again, I'm not here to tell you how to trade, is there's this awesome opportunity that you guys have to be able to read change, to be able to read your indicators, to be able to recognize when things aren't as great as they really should be, and be okay with the idea. To be okay with the idea that it's all right to not be in every move. It's okay to let a move go without you. Because the reality is, guys, if you hunker down and you really focus on the advantages, you really focus on having the best of the best, sometimes it takes a while, but it gets there. Ron posted yesterday that he waited 4 hours for his rules to be met. 4 hours for his rules to be met. And I can tell you right now, it was a $660 trade. So what is that? That's about $150 an hour he made to sit on his hands and do absolutely nothing. That's a pretty good gig, guys. It can't all be yours. And there were so many red flags on this one, Tater Bear, that if you held that, and why would your stop loss be all the way up here? So, and it's okay, and I like it. The read is down, the triggers are down, all that stuff is down. But man, let's make it easy. Let's make it easy for you, and let's look for the opportunity to be consistent. Great post, man. Keep them coming. Keep them coming. And then this was Scott. Long trade momentum, all triggers up, trading into a termination condition. Scott, do you know what my favorite thing in the world is? Is when you know what the problem is and you write it on there, because the second you identify a challenge, you put on your management hat, right? You put on that hat that says, hey, this is problematic. Let me make sure that nothing changes on the small chart. And Scott, this is beautiful, dude. With all that momentum coming up, you know where the trouble is. You get out before the next trouble. I love the way you did this. Is it a high probability trend trade? Hell no. Is it an awful lot of momentum and everything going up? Absolutely. Let's give it a shot. And then when everything says down, you take the same thing. There's your momentum. And when it bounces without divergence, you add to it. And then you make a little money. And then you exit. And the momentum continues to push. And that's that little sideways that you get caught in. And this is what happens when you trade into an area. You risk the decision-making process a little bit. So, Scott, great job using momentum to your advantage. And then I don't see the entry over here, but freaking rock star again. Everything says up and the path is clear, and you went up all the way up to Fibonacci resistance. Nicely done, Scott. Guys, they don't have to be high probability trend trades. I can't stress that enough. They don't have to be high probability trend trades. But when they're not, you know that you got to manage, right? You know you got to put a little effort into making sure that things are working out. Jose, good bottom, 1,000,000 levels of resistance. Trading into the resistance doesn't work. When you let it break, off it goes. Entry after white bar printed at the HVA area off the bar. Well, the HVA area wouldn't have been there yet. You just had a white bar into a bunch of resistance. Looks like you and Gary are talking. That's a lot of resistance. Letting everything roll certainly creates an advantage. Like 10 lines. How often is that going to work for you? That's what I wonder. All right, Miss Cindy, first post. Market's coming down. Hits that mid band, those 1-to-1s, everything begins to roll. 1, 2, 3, 4 divergences. Large triggers go up. So, Cindy, I'm going to give you the same thing that I give everybody else. Tell me why. Right? So when I say tell me why do you believe this line isn't going to hold? Nice, Lyle. Good job, man. And I guess that's my question. So I always do it. Why do you think a couple divergences from resistance, all the triggers below resistance, why are your profit targets up here instead of at the trouble? What made you get in here as opposed to here? And I say this, and I know that you're practicing, and there are no right or wrong answers, right? But what you're doing is you want to create a repeatable scenario. You want to create a scenario that you can do each and every day, that you can say, these are my advantages, these are my disadvantages, this is what I see, this is why I did it, and then you can go back and you can literally back test it. You can go back and see how many times this creates an opportunity for you. And I see the beginning of momentum, right? And I see the pullback to the 1-to-1s, but I'm not sure if you got in here or here or here or here or here. Maybe we can pinpoint a little easier for you. So great post. Thank you for posting. A little more information gets better feedback. And then Jeremy's saying your triggers are off on the large chart. Are they? That was the S&P at around 9 a.m. Let's go look. Those look pretty similar to mine, Jeremy, I think. Enter on the 1-to-1s with a 13% divergence. Perfect. That's what I like to hear. Couple things. Maybe different days back. Might be something. They're not by the bars. No, they're not, are they? So, cool little lesson on divergence, Miss Cindy. The negative numbers mean nothing. They're just a byproduct of the calculations that it takes to create it. And that divergence didn't print till up here. It comes in like on the 3rd. I love it. I love it when you guys get lucky. Great job. 1-to-1s and divergence. Cool. Why not on this one at the 1-to-1s with divergence, right? And that's my whole point. I love that you're in here pulling the trigger. I love that you're posted in the room, and I'm excited to work with you. I just want to make sure it's repeatable. I want to make sure you can do this every day. I want to keep you around. You're the only Cindy in the room. I got a couple Jeremys. We can get rid of him. Just kidding, Jeremy. All right. C-Dub. I love this. Guys, there's that momentum thing, right? Letting the areas break. And that is the mini NASDAQ trading a 21 and a 13, letting it get above the 1-to-1s and snap back, taking a momentum style trade. It could have reversed on you. Absolutely. But it didn't. Nice job. Clear path goes a long way. Momentum goes a long way. Why a 21, C-Dub? Conventionally, people are using that 34 as the large chart. It tends to work well. 34 is too slow for you? I got you. Totally cool. As long as you intended to do it. When I see something that doesn't quite fit in, I always ask just to make sure that you know exactly what you're doing. So, or know why you're doing it. At least you have a reason for it. So good stuff. Great pictures, guys. Let's see what the live market's telling us. So Cindy, let's talk about some cool stuff on yours. So our first lesson, and I love to celebrate stuff, Cindy. You're going to learn that about me. Not a good top, which means that this is not a termination that created a full reversal. The triggers got up above it. So it's not a strong top. And Cindy, this lent itself quite a bit towards your trade. Towards the idea that when you don't have a good top and you get down to that mid band and those areas, a lot of times it loves to finish the move up. So for me, on yours, that's kind of a good look to get into what you're looking at. The second thing that I really like about yours is small triggers get above the large triggers here. That's a key point to do into what you did. And at the place where it did it, your small triggers were getting above the large here as well. Large were rolling above the key areas. The smalls were coming up with momentum. And the problem is you're just not sure where the dance is going to be, which is okay. I like your read. But what I like to see, and I think that this may be just kind of next level, and it takes a little bit of patience, Do you see where the large triggers are up, the small triggers are up, price begins to break above that problem spot, and you get a little snapback? For me, that one's got a little more giddy up behind it, right? I'm on the right side of the synthetics. I'm on the right side of the large, which are up. I've got strong smalls, and I've got a bad top that is showing me that it's failed here. And I know that you like those one-to-ones, and I love one-to-ones too. But when you get caught in between these areas, sometimes there's a dance. And then that's where the dance kind of leads to the upside. Does that make sense? Awesome. My biggest challenge, and I don't mind telling you guys my challenges, this class was developed on your challenge, is as I start seeing this from a bad top, and I take a shot, and it doesn't work, and then I take a shot, and it doesn't work, and then I take a shot, and it doesn't work. And what happens is I miss the best shot, the highest probability shot, and it almost hit the stop loss. How did you determine where your stop loss was going to be? Because that was so far beyond everything. I'm glad you didn't. And then once again, rule number 2 is still in effect, right? Rule number 2 is still very much in effect. So you took a shot. We're just waiting to see what happens. I love a clear path. I'm such a fan of a clear path. And I think that it's difficult because sometimes waiting for the clear path means that you might not get the trade, right? You might not get the trade that you wanted to be in. And it still may go up or it may go down. The reality is I don't know. But I love high probability entries. I love having more things in favor than against. And you're on break even. Perfect. No harm done except a couple commissions, huh? And then guys, on that 50-50, the area that didn't break, first divergence is problematic. Second divergence says don't do it, right? It's just not okay at that point. It's probably going to push down. And sure enough, it did. And then we come through here, 50-50 again. First hit after one divergence. Second hit might have got you. And now it's coming down again. It's pretty cool how you can just keep going through these ideas. Termination, determination. Small triggers down, large triggers up. Whew. Is it going up or down? Hell, I don't know. I just don't have the advantages right now. And then David. Oh, absolutely. Cindy, I enjoy this so much. This is one of my favorite things to do. So keep posting. And if I ever say something that pisses you off, I'll apologize one time. But it's a blanket for the remainder of the education. You've got it easier than me. My coach was my brother. And when you're the sibling and your brother is brilliant, he doesn't sugarcoat like I do sometimes. All right, David, here's odds favorable. Everything says up. One divergence, perfect entry, quick profits. Second divergence, Prince, you said get the hell out. David W. Oh, there you go. So you understand. I tried to trade with my wife. I was a personal trainer too, and I'll tell you what, I couldn't train her either. She's too smart. Stipes on my back? No, not trading wives, silly. Come on, Ron. What does that mean, stipes on my back? Still have stripes on my back. Oh. It's difficult to do things with people you love. Because you don't always take coaching the way you want. David, this was absolutely beautiful. Great management, man. Solid. And what's kind of cool is I just talked through it, and then I come back, and David did it 100%. Well, that's awesome. I love that you're trading with your husband. My wife's too smart. She goes to work. I stay at home with the dog. Works out. Still haven't broken. And then now we have crude oil. Didn't go down, right? Couldn't break through, didn't smash through. Tons of momentum from the termination. If you were going to take a shot, that was it. And now we're up into a divergence high. So, guys, that's the second hour. I'll leave you with crude oil. It seems to be moving the best. We'll see what happens. Third hour belongs to you guys. I want you to go, man, I've been wondering about this. Let me post it in the room. I had this question in my head. Let me post it in the room. Here's a picture. And guys, this is one of my favorite pictures from you guys. Is just pop a picture, draw an arrow, and say something clever like, is this a termination? And what you're going to get out of this is a quick lesson on terminations and why that divergence line is a termination. So don't be afraid just to take pictures of what you see if you're not sure what you're seeing, and we'll talk through it, and we'll get you exactly where you need to be. So good stuff, guys. I'm going to go take a few minutes. I got to stretch. I think I need a new chair. This one's killing my shoulders. I don't know, C-Dub. How many licks does it take to get to the center of a Tootsie Pop? The Wise Owl says 3. I really don't know, though. I don't know what the answer is. Every computer is different. Every computer's got a different power level. Every computer has different video cards, different RAM. There's too many factors to give an answer. The easiest way to do it would be keep adding them until it crashes. And then you'll at least have a baseline, right? Sorry, that wasn't real help. And for those of you that are new in the classroom, I am not your best bet for tech. Jason is always your best bet for tech. But there's a lot of things that I've screwed up and had him fix for me that I can talk you through. So always feel free to ask. Just don't get your feelings hurt if I have to send you to Jason. And there's your termination condition, right? Bloop. Down it goes. All right, guys. I'll be back in 5 minutes. Post them if you got them. We'll see you in a few. right, y'all, here we go. Final hour. Hey, John Novak popped in. He has been running the new version for 11 days straight, no crashes. Intend on having beta testing start this weekend or early next week. So if all goes well, by the end of next week, Ninja issues are 100% resolved. Gotta love that. Thank you, John Novak, for all your hard work. Only 100 million instructions in the code? That's it? That doesn't seem like a lot. All right, Tony. Termination, reversal. Oh, I see. I like everything about this one, Tony. John said perfect, too. You think it's going to be a top. It comes down. There's your gap theory. Right in the middle of the trade. Uh-oh. You got your first profit target at 84.8, that blue fib. That's okay. Bring it back up. It'll still be active. If your stops are in place, Tony, it's all good. Guys, this is a great example of how to use the gap theory. And Tony, I know you're coming back up right now. I'm going to take a picture of your picture. And we'll see. We'll talk through it a little bit. All right. So price comes, not a great top, hits the mid-band. So we're thinking to ourselves, all right, mid-band hit. Large triggers are a full bar away, and it sure enough closes the gap right to those large triggers, right to the synthetics. And then, Tony, when everything on your chart says down, everything is angled down, momentum is down, fibs are below the areas, so the area is considered a termination condition above you, you take an entry right at that red line, and that is a brilliant entry. The one-to-one support it. And then I like to play the management game a little bit. The initial stop is perfect, right? Out here where the market shouldn't go. Once I get a reversal bar, I'm not shy about dropping that stop a little bit. I'm not shy about protecting my assets. And then you certainly don't have to, but I'm a fan. I'm a fan of watching it right here at that 85.6 and just make sure that it gets through that divergence low off that mid-band. And then once you get that first target, yeah, no reason to give anything back. Great trade, Tony. Picture perfect. Beautiful entry. And then John Novak. Bad top. Different look, right? Large triggers are above the area, but he's got a ton of momentum. So he lets a smaller chart roll. Pulls back to the resistance, no hesitation in the small triggers. It's a trend trade. Absolutely, it's going with the trend. It's not a high probability trend trade, but this is an awesome example of how you're going to begin to incorporate your chart reading into more trades, more opportunities, understanding with this much momentum and this bad top that all of these fibs create an awesome target. John, your sync is off a little bit. No divergence. Yep. And understanding what your challenges are, right? He knows that he's trading into one-to-ones. Those can be problematic, so he's watching. He knows that if price pulls back to resistance with that much strength in the triggers and change happening here, he knows he's probably got a good shot pushing down to the next area. 2 lower divergences gives him that same warm, fuzzy feeling. There's a lot of chart reading that goes on in these charts, and it used to aggravate me when he would drop them in here because it doesn't fit the rules, and that used to get people a little bit. But the reality is this is where you're going, guys. Everybody's going to this great place where chart reading takes you to the next level. Pivot stop out to support, to weak triggers pivot stop out. Great lesson here. When you come into a termination condition with that much momentum, very often that area gets retested. And sure enough, it did. But now we're retesting with very weak triggers, right? That's a great look. But it keeps you from getting too married to shorts off of that look. Now it comes in, retests, hits the resistance. Much better look for potentially putting in a top. Smalls break through. Oh, John, you had a termination condition on yours. You didn't show it in the room. Just added even more weight to that one. Guys, this was John Novak's entry. The one thing that he didn't show us is that he came straight from a termination condition. He came from a termination that caused the beginning of that reversal, and he let his small chart lose all our upward movement. Nicely done, John. Very nicely done. All right, guys, what do you want to talk about? We are in the last hour, and you guys get to lead the way. What you think? So what do we see on the NASDAQ right now? We see a termination that caused a full reversal. We see odds favorable momentum pushing to the bottom. But when I look at my small chart, I've got 3 divergences in the same price range, don't I? Absolutely. Great read, Tate. Does it mean that it can't go down? Of course not. Does it mean that I've really lost the advantage here? I feel like it does. And the small triggers aren't smashing through. And the large triggers are above. Cav, thank you for saying that. I want you guys to see something. This area isn't broken yet, right? This area isn't broken yet. This area isn't broken yet. This area isn't broken yet. And I've got 3 divergences. Whew. That's fighting a lot, isn't it? Oh, and my small triggers are on the wrong side of the large triggers. And I'm going to tell you guys right now, every now and then, it's just going to smash to the bottom. And you're gonna start questioning everything. You're gonna start saying, "Oh man, it went anyway. Should I have held through 3 divergences? Should I have fought 4 areas that aren't broken?" Right, guys? There's always gonna be time. And look at the gap back to those large triggers. It's pretty close to the gap theory, not quite. Let's see if those 3 divergences are enough to at least close up here at those triggers, and they may not. I really don't know. But I know for me, it's not a short yet, right? In order to have a short, I want to get to the other side of those 3 divergences. I want them to kind of nullify themselves the same way a Fibonacci area would. I want to see those large triggers come down more, and I'm okay not catching it. I'm okay not being a part of it. And the longer you stare at it, and the gap is still pretty big. It's not 100% gap theory, but it's still pretty big. And check this out. Bad top. Doesn't work. And then Miss Cindy, I'm sorry. I know you got out break even. But do you see how they never got above? None of my triggers ever got above resistance. Isn't that crazy that it really can be that easy? And that's that 90%. Small and large don't agree. Terminations both directions. It's okay to not get caught up in this little area. And now I've got a termination that's got everything rolling to the downside. So we'll see what happens. There's 3 divergences in the same price range. How's that for a reversal? Odds favorable momentum. We're just trying to get through areas, guys. Should we start writing New Year's resolutions? I think that's mine. I'm going to reread this book, How to Commit Financial Suicide. One Easy Step by John Novak. Trading Against Strong Triggers. Trading Indetermination Conditions, guys. Those are the two biggest killers. Shooting for 90% wins. We'll be happy with 80. I like it. The only thing that I don't care for on that, Cav, is I would rather shoot for rules met every time. For me, I'd rather shoot for rules met every time, because that's where those advantages come in. And then John, of course, after I talk about 3 divergences, is it your trade? John gets short off the 3rd divergence. And this is why I kicked John Novak out of the class. But the reality is you guys will get to a point where you'll be able to discern all the information, right? And you'll make a decision. And you'll be able to make a pretty pragmatic decision based on whether or not it's your trade. But guys, that doesn't fit any rules. None that we teach in here. But it very much fits John Novak's plan. Because of the momentum, guys. Remember when I said momentum breaks areas, momentum fixes mistakes, momentum carries a market. If you pull this little trick when you want to develop confidence in the triggers, Tater Bear, this is for you. You want to develop confidence in the triggers? Look at that look, and look what it does. Pretty awesome, right? When can I pull a fast one? When the triggers are the strongest. When can I get away with something? When the triggers are the strongest. It doesn't mean that you should make bad decisions or be reckless, but it means that if you're gonna be a little bit outside of the box, let that be your trigger look. Does that make sense to everybody? Because what happens is when you try to get outside of the box with this look, it doesn't work as often as it does with this look. It doesn't work as often with this look as it does with that look. So that's a good trigger lesson. I think that's a great focus as you go into the new year. If triggers are your thing, Tater Bear, learn how to trust them. Learn how to trust that much momentum. Learn how to embrace the idea that strong triggers lead the way. That strong triggers are, I think, the best advantage you could have in a trade. And when you've got that odds favorable momentum, great things tend to happen. So there's that 50-50, right? Smalls, tons of momentum, strong or cranking, and it pulls right back to resistance inside of favorable large triggers. When am I willing to take a shot? When I have the absolute best momentum. And where's it going, guys? With all that momentum, can we pick a spot in the distance that it's likely to hit if it's going to continue? I'd put my money on 17,104. If the momentum is likely to continue in the direction of the trend, doesn't it make sense that momentum is likely to take you to that next fib sitting in your way? So if you're in this trade and you've already got your risk established and everything says down, it's a 50-50. You might make the choice that a second divergence takes you out, or if you decide to hold it, you can start creating intelligent targets, guys. But the path isn't clear yet. So since we know what we're up against, we can manage aggressively. 2 ticks above, right? And if we got in at 18, well, we've already made our 100. Let's go break even, and let's see if that momentum carries us down to the next key fib. You see how that's working, Tater Bear? No reason to lose on this trade. You've already gotten in. It's already going with the momentum. You've already been paid on a contract. Why not? So that's what you have to ask yourself. Why didn't you pull the trigger? What scared you out? And John, you added on at 13? Oh, Cav did. That was Cav. I saw John typing. You got it 1750. Love it. And then you added on at out at 13. Why did you get out at 13? All right, Tater Bear, that's what I needed to hear. Let's go through it. Oh, okay. You're going to learn to stop giving those magenta dots so much weight. You will eventually. All right. Tater Bear, you said... Right on, Tony. Show me a picture. I'd love to see it. Tater Bear, you said that 2.5 points is too darn close, right? I'm not doing that 2.5 points. And then Tater Bear, there's your window of opportunity. Right here. And this is a great lesson on the idea of trading the pullback, right? Because it wasn't 2.5 points. It was from the pullback all the way back down. And there was so much room for money to be made. So much room for money to be made. And notice that John has his first spot at the divergence low, his first trouble spot, and the second one down at the fib. So, and this is pretty common. Yeah, that's the magic of rule number 3. The magic of rule number 3 is that it gives you room because we sell pullbacks. And that's why we use the idea that price reaches the area, because that's your catalyst, right? That's what gets the decision making done. And then you have to ask yourself, what changed? From time of entry to time of exit, did anything change other than small triggers getting in favor of the trade? And then we get two divergences, one tick. Big difference between 6 points and one tick. And let me show you a cool picture of how fibs come to be. Tater Bear, you want to learn more about this stuff? This is awesome. This is such a good lesson. And I remember this from like 20 years ago, 25 years ago. My brother's explaining to me how fibs come to be. It was the birds and the bees of fibs, guys. And when you open up your software, it's literally measuring every swing in the market. Every swing in the market. Every up, every down. It goes back over a historical time frame. It creates synthetic time frames forward. It is unbelievable the number of calculations that go through to create these great areas. And when all the calculations are done before the algorithm is run, this is what your chart looks like. These are all the different projections. These are all the different alternates, all the different retracements. And it's a mess. And if you're my age, you remember Yar's Revenge on 2600. That's what it looks like, right? There should be a little fly shooting through it any second now. But what your software does is it weighs them and sorts them. And it says, hey, these are the biggest concentrations. These are the most important. And that's what gets us to these key areas. So if I'm 5 or 6 off, I haven't really gotten into that concentration point. If I'm 1 tick off, I feel pretty good about saying, that's cool, let's take profits. And what a lot of people do is instead of having a profit target on the fib, you'll see that they'll put it 2 or 3 ticks above, right? I need it to get within a point. I don't need it to be right on top of it to take profits, because you'll see very often, sometimes they'll overrun a couple ticks, right? Sometimes they'll overrun a couple. Sometimes they'll stop directly on it. But if I'm looking for profits, I'm remembering that fibs are areas. And that's a good lesson there. And it still may continue down, right? The momentum is still cranking. But you already had your best entry, and now this one becomes a little lower probability because of the two divergences, and the path's still not clear. All right, Tony. Love it. Termination, full reversal, pull back to resistance inside of favorable large triggers. Beautiful. Did you get out at the fib or the one-to-ones? Tony, you're rocking it. Why not, right? Get out of that big, ugly blue line. Outstanding job. I mean, I could teach a class with that. Beautiful, Cav. Oh, you didn't take them. Oh, no, you went long? Yee. That's bold, Cav. If you can't go short, why not go long? Cav, give me heartburn. Ugh. Eventually, you'll get so confident, you'll take them both directions. Whew. Flip a coin. You got to remember, what's good for the goose isn't always good for the gander. What's comfortable for one person may seem crazy to another. What is easy for me might be difficult for you. Everybody's in a different place, and everybody sees things differently, and everybody gets these patterns that register differently. And Cav's probably saying a tick off of support with a pivot stop out. He won't. You could lose all the money in the world, and he's still going to pay his rent tomorrow. So it's aggressive. It's aggressive, but totally up to you, man. That fights everything on God's green earth. And it'll let you get lucky just enough to do it when you switch to a 10 lot. And John, you get short after 2 divergences and out with 3. As much as you don't like it when they don't make it, you have to follow the rules. Amen. And then Chadwick used to like to use an extended line from the most recent pullback to see if the move is complete on the 34.5. I'm not sure what that means. Can you show me in picture form? I'm always down to learn something. First short's a little sketchy, Novak. Second and third are perfect. I'll scold John too. I'm not scared. He's all the way across the country. I'm pretty safe. Don't do this to me, Novak. Get on a flight tonight. We have the same spine. I know exactly how to get you. Now, guys, there's one of your 20%. Odds favorable. Let's see what you got, Chadwick. Oh, you're using trend lines. So you're saying if it pulls back up above, you think they've probably done what they want to do? I've never really used trend lines. I know a lot of people, I've watched a lot of people use them. Yeah, John, I've seen John do it. I'm pretty ignorant in the ways of the trend line. I try not to give myself too much to think about, to be honest with you. I try to give myself just a couple things, but everybody's different, right? Everybody's different. Yeah, Tony, it's hard. I was very, very fortunate that I came into Nexgen with no trading experience. I had no preconceived notions. I People would say, "Hey, Mark, what do you think of Elliott wave?" And I'm like, "Who's Elliott? And why is he waving?" Knew nothing about it. Knew nothing about trend lines. I didn't know what an EMA was. I still have to think about it. So for me, it was a pretty big advantage. My life has always revolved around momentum, a clear path, and an entry area. And I find that, and it's just me, and Chadwick, always do you, right? But for me, the second I add this blue line in there, it's going to create a bias for me. It's going to make me believe that something is done, even if my indicators don't say it. And for me personally, I'm a huge fan of finding the reason to get in instead of the reason to stay out. Everything still says down. The momentum is still there. Yeah, less is much better for me. I'm not going long yet. I'm not pulling a calf. Cav, it's been so much fun watching you grow as a trader. You have progressed so much in the last 30 days. It's pretty outstanding. And you guys don't know this, but I learn from you. When you post things in and I have to talk through them, I learn things. Ron C's momentum style trade had me looking for advantages and trades beyond what I'm doing, right? When I have to talk about the gap theory every day, it keeps me focused on it. When I talk about termination conditions. And guys, that's why I think taking the time to post, taking the time to type, really go through and talk about what you're seeing. Make it vocal instead of just that little momentary shit didn't work, right? There's nothing to learn from that. So you have to talk about multiple divergences and you have to talk about, well, what am I looking at? What do I see? And the idea is that you can just keep doing it, right? Think of any sport that you've ever played. One of the biggest words used by coaches in little leagues is fundamentals, right? Learn your fundamentals. Get your fundamentals down. And that's the key. Your fundamentals are recognizing the advantages so that when they're not present, you have the opportunity to manage. Hey, Safia, hope you had a Merry Christmas. And then when you start learning, hey, this is an awesome trade, but it's lacking a clear path. So I'm going to manage it a little bit, right? I'm going to make sure that I don't sit and hope a little bit. Or I don't have the best momentum, so let me make sure that there's nothing in my way. And if you begin speaking to yourself in terms of advantages, what happens is you recognize when it's appropriate to be a little more aggressive, when it's appropriate not only on exits, but also entries. When you're coming from a great top or bottom, it gives you the opportunity to really grab hold of something. And when you have a clear path, maybe you can go a little outside on the entries. So start speaking to yourself. Oh, thanks, Safia. I had an amazing Christmas. I got to go see my boys in Austin, and our new dog met my son's dog. Woo! That was crazy. Have an awesome afternoon. So, what's the difference? Right on. You're in Seguin, right? So this is where I ask myself, and this is kind of cool, guys. What's the difference between these three divergences and these three divergences? First year anniversary? Oh, happy anniversary. You guys, fibs. This one, the triggers are all beyond the fibs, right? This one, all the triggers are above the fibs. These are the little subtle things that you're going to start to recognize. On this one, everything is pointing down. At the third divergence here, the small triggers are pointing up. The large triggers are starting to roll. And guys, this is one of the amazing things about repetition. Um, when I talk about momentum, oh, that's for John. Oh, let's read what John said. When you figure out how to read the software, then you figure out what fits your personality the best, which setups, which reads, which looks. You may find you're more of a trend trader. You may find you're better at momentum trades. And you have to spend time doing replay and study and ask the question, what do I want? What do I need? What makes me happy? Amen. So when he talks about momentum, Andy, what he's talking about is a trade that relies on momentum for entry and continuation, not necessarily a trend trade. And there is the list. And Safia, you are the example of this phrase right here. Through simulation, study, class feedback, and continuous practice, you'll create your plan through chart reading, guys. And that's my goal for you. When I was a personal trainer, I used to tell all of my clients, no, it's a momentum trade, Andy. It's a different type of trade. It doesn't rely on the three advantages, so to speak. A momentum trade, let me find it. I mean, as long as you're trading with trend and momentum, everything is going to be some sort of continuation. But a momentum trade relies more on the ability to, let me see if I can find an example, to take odds favorable momentum and take a little unorthodox approach to it, really embracing the idea that these strong triggers are going to continue the market, that good top or bottom is the reversal. So what it is you may not have an area inside of favorable large triggers, and it may be a tiny little pullback to a 1-to-1 or a fib, and it's just taking advantage of momentum is all it is. And if you look at some of the traders in here, you'll see that rather than, and I'll give you a visual example of it, rather than taking pullbacks, what you'll find is they take a little slice from here to here. And that's all they're looking for, is just that little chunk of goodness where the momentum is its absolute best. And then with that, they're taking small hits. They're taking base hits, but it's adding up into big days. And I'm going back and I'm trying to find a great picture of that where C-Dub does that. C-Dub has gravitated a little bit towards a momentum style, where the momentum on the large chart says he's going to look for a small chunk of it on a small chart. Ron C is the master of the momentum trade, and he's spent a lot of time showing people what he does so that they can formulate a plan from it. But it all revolves around having the absolute best of the best momentum. And the big difference, right? Small and large below the area, you get one more push with all that momentum. All of them above the area with three divergences, now we're starting to see a push up. And yeah, the problem with new traders is with momentum trades is they see 168 of them a day. And I'll show you the biggest problem with momentum trades is new users will take momentum trades when there's not momentum. They'll take momentum trades against the trend. And the key is you've got to still have that momentum. You still have to have that clear path. It's just a little different entry. And what you're betting on with a momentum trade more than anything is that the small crowd doesn't show up to the party. With a momentum trade, you're betting that the small crowd isn't going to be there. And if they are, they're going to steal the momentum, guys, and you have to be willing to exit. Most momentum trade losers come from people refusing to accept that momentum is gone. That's up to you. Triggers inside, no clear path. That's up to you. Are you going to take a momentum style trade without momentum? You're going to have to name it something else, like Steve or Joe, right? And then Ron heard me talking. Base hits pay bills. Notice that the smalls are outside of the large. He gets beyond the trouble, so the path is clear. And rather than waiting for a pullback, he's banking on that level of momentum just take quick profits. A clear path is great, C-Dub, but if there's nothing pushing it, right? Have you ever been in the middle of a lake in a sailboat with absolutely no wind? Doesn't matter how much room. Did I? Oh, no, I didn't. It paused it. For some reason, it paused it. Let me stop streaming real quick and try and come back in. Thank you for that. I had it up. The Discord's messing with me. It did this a few weeks ago, so I'm trying to bring it back up. So, C-Dub, what does momentum do? Odds favorable for the market to continue, right? Arrgh. And guys, I'm trying to get my view back up, but it doesn't appear to be coming back up. I'm just getting these little blue dots of death. Sorry. So if you're going to take a trade banking on momentum, make sure that it's there. And if we know that those weaker triggers precede reversals, and that's the easiest way, and they precede deeper pushbacks, it's difficult to consistently take a trade that pushes in the direction. And guys, it looks like Discord has given up the fight for me today. Let me try it one more time. I have a big exclamation point. Let me stop streaming one more time and give it just a second. Hey, Tony, have a good one. Great trading today, man. Glad to have you in the class doing your thing. Try it one more time. I'll drop the resolution and the frame rate and see if that gets it up. Well, guys, it would appear that the visual is about over. I guess that was good timing. We're 10 minutes before the end. So C-Dub, I'm not saying that it's risky. I'm saying that there's two ideas behind momentum. And there's two pretty good looks with the trigger lines and everything that's going on. And let me find it real quick. And I'll post the picture in the room since I can't put up the picture right now. And embrace the idea on this one, I think, that anything can happen is just that. You can see the picture that I just put in the room. Weak triggers, anything can happen. It can still go up, but it's less likely, if that makes sense. So, good stuff. Well, guys, Discord's not going to give me my screen back. I apologize. So I'm gonna shut it down. I'm gonna call it a day here. Thank you so much for all the participation. Thank you so much for you guys that are posting, that are asking questions. If you take trades this afternoon and you want feedback on them tomorrow, please bring them to the class. If you do market replay tonight and you want feedback on them, bring them to the class. Guys, getting together with you guys and looking at your charts and talking about it is one of the best. Cindy, thanks so much for being here. I saw you sitting in the background for a while. I'm glad you're participating. Keep going. We'll high five virtually when you're making more than your husband. It'll be fun. I love husband-wife teams. We get a lot of those here. It's a lot of fun. So, guys, have an awesome afternoon. You guys be good. Stand up, walk around. And I will see you tomorrow morning at 9 a.m. We'll do it one more time before the new year rings in. Take care, everybody. Be good.